Funds and partnerships. This chapter is going to quickly cover the major questions regarding funds, partnerships, as well as annuities. Let's begin with funds. Now, you should be familiar with the differences between a closed-end company and an open-end company. And there are 5 calculations pertaining to an open-end fund that you should be familiar with. Closed-end company. Now, closed-end companies conduct a one-time offering. Investors buy and sell their shares in the open market, and the share price is based on supply and demand. Now, note that the price of a closed-end company's share is based on supply and demand, and therefore it could trade at, above, or below the share's net asset value. Open-end companies. Now, open-end companies, commonly referred to as mutual funds, continuously issue and redeem shares. Investors will buy and sell with the company, and the net asset value is calculated on a daily basis. Now, open-end companies or mutual funds are continuously issuing and redeeming shares, and due to this fact, each share is considered a new security and therefore requires a prospectus. And the prospectus of a mutual fund must disclose the fund's expense ratio, and this will be our first calculation. The expense ratio is determined by dividing the fund's total expenses by the average net assets. Now, exam questions will typically contain both of these figures for you. So the expense ratio is quite simply the total expenses divided by the average net assets. So for example, if a fund had expenses of $2 million and it had average assets of $200 million, the formula would simply be $2 million divided by $200 million to arrive at the expense ratio of 1%. Net asset value per share. Now, a company's net asset value is determined by dividing the fund's net assets by the number of shares outstanding. So the net asset value is going to be the fund assets minus the fund liabilities divided by the outstanding shares. Maximum sales charge. Now, when purchasing a mutual fund with a front-end load, an investor is going to pay the net asset value plus a sales charge, and this is referred to as the public offering price. And the maximum sales charge allowed is 8.5% of the public offering price. To determine the sales charge percentage, it's a 2-step process. The first step is you want to subtract the net asset value from the public offering price to determine the sales charge. Then you just want to divide the sales charge by the public offering price. So for example, let's consider a fund with a net asset value of $19 and a public offering price of $20. Now, step number 1, you want to subtract the net asset value from the public offering price. So you would just take $20 minus $19 gives you a $1 sales charge. Step number 2, you just want to divide the sales charge of $1 by the public offering price of $20 to arrive at the sales charge of 5%. Offering price with a breakpoint involved. Now, the exam may have a question that will ask you to determine the price of shares if a certain dollar amount is invested into a front-end load, which qualifies it for a breakpoint. So for example, if a fund has a net asset value of $20 and $50,000 is invested, the investor will receive a 7% breakpoint. So to find the offering price per share, you want to divide the net asset value of 20 by the reciprocal of 1 minus the sales charge. In this case, it would be 1 minus 7%. So we would take the net asset value of 20 divided by 1 minus the sales charge, which would be 0.93, equals an offering price per share of $21.50. Number of shares at breakpoint price. Now the question may ask you, how many shares can be purchased at this price? So you simply want to divide the principal amount by the offering price to get to your answer, which in our case would be $50,000 divided by $21.50 would be an answer of $2,325. Annuities. Now the main concept of an annuity is investing after-tax dollars that accumulate tax-deferred. After-tax dollars that accumulate tax-deferred. Now, annuities are mainly used as a tool to fund retirement. Now, basically, you're going to be expected to know the differences between a fixed or variable annuity, the tax treatment of withdrawals, and the different payout options. Now, the two major types of annuities are fixed or variable. A fixed annuity is simply a contract. It's a contract between an investor and an insurance company. Now, an investor will pay into the contract until the payout period begins, when the insurance company makes guaranteed payments to the investor, and this is possibly for the remainder of the investor's life. Now, you'll be expected to know that the risk is upon the insurance company. A fixed annuity is not considered a security, and hence there is no prospectus requirement. An investor's payments into a variable annuity are placed into a separate account and invested. And you're going to be expected to know that a variable annuity is considered a security, and therefore it must be sold with a prospectus. The rate of return is not guaranteed, and therefore the risk is upon the investor. Now also note that an investor in a variable annuity has voting rights regarding the management of the account. Taxation. Withdrawals prior to the payout period will be treated using the last in, first out method. This is commonly referred to as LIFO, the last in, first out method. And the withdrawal will be considered earnings and taxed as ordinary income. Now, if an amount exceeding the earnings is taken out, it's going to be considered a return of after-tax contributions, and it will not be taxed. Payout options. Now, the names of the payout options are very descriptive. We'll start with straight life. Now, a straight life annuity provides monthly payments for life. It has no beneficiary. Therefore, this is the riskiest, and it maximizes the payout. So for a straight life, you want to remember this is the riskiest payout option, and it maximizes the payout. The next one is unit refund life. Now this is going to provide periodic payments for the value of the contract, and the beneficiary will receive a refund of the remaining value of the contract upon the annuitant's death. Again, this has the word refund in the name of the payout option. Unit refund life. Periodic payments for the value of contract, and the beneficiary will receive a refund of the remaining value of the contract upon the annuitant's death. Life with period certain. Now this payout option provides monthly payments for life. If the annuitant should die before a specific period, the beneficiary will receive payments until the specific period is reached. Again, that is life with period certain. The last payout option is joint and last survivor life. Now, in this payout option, payments are made to two people for life. And when the first person dies, the second person will receive only their payments for life. Partnerships. Profit and losses from limited partnerships flow through directly to the investors for consideration on their personal tax returns. Now, the main concepts to understand for this section, I'm going to go through one at a time. Number one is general partners. General partners must contribute 1% of capital, and they make the decisions regarding the partnership, and they have unlimited liability. Remember that. General partners have unlimited liability. Limited partners. Limited partners are passive investors. They contribute the bulk of the capital. They have no decision making regarding the program, and they have limited liability. Their liability is limited to the extent of their investment. Subscription agreement. Now, a subscription agreement states the investment amount and whom to pay. And a limited partner is considered accepted once the general partner signs the subscription agreement. Again, a limited partner is considered accepted once the general partner signs the subscription agreement. Loans. A partner's investment in a program is known as their basis. Now, recourse loans will be added to a partner's basis. However, non-recourse loans will not increase a partner's basis in the program. Losses. Passive losses can only be used to offset passive income. So for an example, if an investor had $10,000 in passive losses and $8,000 in passive income, the remaining $2,000 in passive losses may be carried forward and applied to future passive income. Selling. Now, when selling a partnership interest, an investor may deduct all passive losses against future income, whether passive or non-passive. I'll give you an example on this one. If an investor sells his limited partnership for $10,000, and at the time of the sale, the investor had $15,000 of passive losses being carried forward, the gain would be offset, and the remaining $5,000 in passive losses can be used to offset future income, whether that income is passive or not. Flow through. Now, usually these questions will give you all the figures necessary to figure out flow through to the partners. I'll give you an example on this one as well. For example, a partner's portion of operations included revenues of $50,000 and operational expenses of $48,000 and depreciation of $5,000. Now, the investor's flow-through would be calculated as $50,000 in revenue minus $48,000 in operational expenses minus $5,000 in depreciation expenses for a passive loss of $3,000. Actual income. Now, in the example above, the actual income from the partnership attributable to the investor would be the revenue less the operational expenses, $2,000. Limited partnerships use depreciation or depletion expenses to minimize the amount of taxable income to an investor.